Here's everything you need to know about spreads, on how they work, what they are, and how you can account for them when actually trading yourself. Hi there and welcome back to the Vertex Investing channel. My name is Ben and this is everything you need to know about spreads. So let's get straight into the video. We've had a lot of questions about this, regarding how spreads actually work, how they affect your trades, and why are they actually there and what affects them. So in this video I'm going to cover everything that you need to know about it in the most simple form as I possibly can. What are they? Spreads are how businesses like brokers make money. It's their entire business model is to make money from fees. Not your money, not you losing, not you winning. They don't actually make much from that. They actually make all of their money from fees, e.g. spreads, swaps, which is for another video, or even commission based off your trades. Some have monthly membership fees. This is how brokers actually make their money. Now, how do they work? So you don't have to do anything directly with spreads. They are automatically applied to your trades when you actually take part in the market. You may notice when you trade on your trading platform there are two lines on your chart. If not, you must enable these to figure out how spreads going to affect you. One where price is, candles display this. We call this the bid line, and this is where we actually enter the market. The other line is always above the bid line, which is called the ask price line, and this is the price that the broker gives. We enter on the bid and we exit on the ask price. So what does this all mean? Well, as a general rule of thumb, when you're selling you use the bid price, and when you're buying you use the ask price. When you enter a short you obviously sell, but think of it as buying when you close, and same goes for entering a long. You're buying when you enter, but you must think of selling it when you close. So we will get into examples of this right away. So in this example right here, you can see the highlighted mouse. The bid price is the green dotted line right here, and the ask price is the red dotted line above it. So in this scenario, spread is actually less than 1 pip because I am on a raw spread broker, and that's just great. Now, the lower the spread, the better. We are on the 1 minute time frame, so it looks quite large, but it is extremely small. The difference between this is why we always start trades in a loss. This is spread. This is how brokers make money. For example, in this scenario, if I was to buy here at market execution, my trade would be executed at the ask line price, yet price is actually at the bid line. So if I was to buy, my my entry would actually be here on the red line and price would be here. So I would immediately start in a loss depending on what my lot size was and multiplied by the pip size here. That would be the difference in spread. That is spread, and that's how much I would start my trade in the negative. As soon as you trade, you will be in a loss. Now, this is why you always enter the trade and you see red immediately. This is normal, and this is why this happens. When I close the trade, I'd be selling and I'd be getting the bid price. So, for example, if I bought here and price came up here, and for example, let's say price was at this wick here, but spread, my bid line was here and my ask price was here, I would always get the bid price, which is where price actually is, where the candle shows, and the ask price above it, that wouldn't actually mean anything when closing the trade. Similarly, if I was going to sell, I'd be selling at the bid line where my order would be executed. However, I'd be accepting the ask price when you close. See this as buying to close. Buys use ask price, as we said in the general rule of thumb. Buys use ask, sells use bid. So in this scenario, if I was selling here, I would actually get my order where price actually is, but the price I'd be accepting in terms of profit would be the the ask line above it. So in this scenario, again, I would start in a negative because my sell is here, and the price I'm actually accepting when I buy, e.g. close, is obviously the ask line, which is above. And that is why, again, you always start trades in a negative no matter whether you buy or sell. Hopefully this is really straightforward for you guys. I'm trying to keep it as simple as possible. So again, immediately be a negative when I execute my trade. This is why the smaller the spread, the better, as I've just said. Now, we're going to move on to sell limits, and I'm going to show an example and try and annotate some on the trading view chart, and then we'll look at buy limits and potentially look at some sell stops and some buy stops. So I don't need to take any special consideration in the entry in a sell limit. So as soon as price hits here, I get entered in as usual. As soon as my candlestick touches my limit, I will be triggered in. In theory, that the brokers have glitches or any form of data feed leaks, and you may not be triggered in, but as a general rule of thumb, you will be triggered in. And there's no problem with this. Spreads aren't going to affect your entry. You always get the bid price when you sell. Like we say, bid, sell, ask, long. Okay, so special considerations are for stop loss and take profit. In this scenario, if my spread was actually, my ask line was up here, I'd have already been stopped out in this scenario. And that's again why you look on TradingView, and you may see that you were in the trade and you haven't looked at your MT4, but you've actually been stopped out on MT4. This is why. It's because spreads may have stopped you out. Now, you should always add your broker spread to your stop loss in a sell position. So in this scenario, say my spread was 3 pips. I would add 3 pips to what my stop loss would be. So in this scenario, my stop loss is above my entry criteria, which is here. Again, these aren't real trades. I've just put them here for the sake of it, for an example. And I would say my stop loss was here. I would have to add 3 pips on top of this just to account for spreads. Now, spreads change, they differ, but you want to be doing it at the time of placing your trade, and that's how you want to be measuring it. So as soon as the ask price hits stop loss, you'll exit. Again, because when you're selling, you have to buy to close, and that's what the broker's taking for your close, is the ask price. Again, I'm going to repeat this many times in this episode. Buy is ask price, sell is bid. Now, you got to remember, when you're selling, you buy to close, and when you buy, you sell to close. It obviously doesn't actually happen like that, but that's the way you should remember it. So you must factor that into your stop loss, otherwise you are going to be stopped out. Same with your take profit. In the scenario, if this was your low, say it hit this low to the pip, and spread was actually, say, 5 pips on the scenario. That is quite a high spread, I know, but say if it was, and price hit there and flew up, your take profit would not have been hit, because for your take profit to hit, the ask price actually has to hit your take profit in a sell. So I'm going to quickly head over to TradingView, show you some more annotations and go into a tiny bit more detail if possible, and then we'll head into buy limits. Okay, so we're on TradingView, we're on the gold chart. Let's use the 1 minute chart. As gold is the only thing that actually has any form of spreads on TradingView in this current time. Well, there's a few spreads here and there, but they're quite tight, so we're going to use gold just because it has the biggest spreads. So let's get into it. For example, if I was to take a sell limit from here, my stop loss was, let's say, just 1 pip above this high, I would be triggered in as soon as price came up to here. I would have been triggered in. But for example, if this spread line came up with it, and say spread was here, as soon as I get triggered into this position, I would be stopped out immediately. And this is why sometimes you take a sell limit and your trade doesn't even play and you're gone. Even if price does this, you've already been stopped out. That's it. Spreads have taken you out. Now that's why you have to account for spread. So in this scenario, we can see it doesn't actually show me spread here. So it's 3 pips. So I'd have to add 3 points on top of this, which obviously I've still got the draw tool on. So it would have to be here. Now that would now be fine if price triggered me in. Always remember, when you're actually adding spreads to your stop loss, you have to adjust your risk size. So if you say you had a 3 pip stop loss and your lot size was 0.4, for example, you make sure, if say your spread was 2, you add 2 pips to that, your stop loss is now 5. You have to readjust the risk that you're actually going to take in terms of lot size and not get triggered out by this. So in this example, price actually came up and triggered us in this scenario. I wasn't even watching. So in this scenario, that was a perfect example actually. I don't know if it stopped us out, but you would have seen price come up to here and spread would have been up here. If I had my stop loss down here still, I would have been, like right now, this ask price is actually above the stop loss, but price isn't. I've already been stopped out. Even though price hasn't actually touched it, I have been stopped out due to spreads. But if I keep it here, I still don't think I've been stopped out yet. Potentially from this peak of the wick here, But again, it doesn't matter, it's not a real trade, I'm just giving an example. But for example, if my take profit was in between this sort of spread zone right now, in between the bid and ask price, sorry, during this time, I wouldn't have actually hit take profit until the ask price has hit it. So right now, obviously my trade would have closed now because ask has fell below it. But if it doesn't, and we trigger, say for example, to the pip, like right here, let's just say I entered here and that was my take profit. With the current spread being 3 pips, 2 pips, I would not have actually closed the trade here and potentially even lost right here. So you've got to make sure you shorten your take profit a little bit. You are going to lose a bit of profit in the process, but it's best to actually close the trade than for example in this scenario and actually lose. Obviously this is the minute chart, so it's not too great of an example, but hopefully you get the point. And yeah, that's pretty much it in terms of editing your stop loss and your take profit for sell limits. Again, if you were selling at market execution price, you would get, right now you'd get the bid line, but again, you are taking the ask price, so immediately I'd be in, right now 1 or 2 pips in drawdown again, and I may get stopped out early, and my take profit needs to be slightly shorter to make sure it actually gets hit. So we're going to head back to the presentation and we'll take a look at buy limits. Okay, so buy limits. Remember, when we're buying, we take the ask price, and when we're selling, we take the bid price. I've said this many times. Now, in the scenario, we can see price is clearly below my limit right here. Candles are below. But, however, the ask price is still way above my entry point in the scenario. This is a way better example than the one that I just showed on sell limits. This is why you'll often see price hit your entry, but you won't actually be in the trade. So usually what I tend to do is I try not to be on MetaTrader at all, but I tend to have a quick look to make sure that I'm in and to make sure that I'm out at certain points. For stop loss, take profit and entries, I always try and check MT4 to make sure that it has updated the way I want it to. And then we go from there. So in this scenario, I wouldn't have been tagged in, and this is why. If you have the price come down and tap your limit to the pip, or go below it even, and you still weren't in, this is why. And this is why it's important to pick a good broker that has great spreads. It's purely because of this reason. And obviously the fees will be lower. So again, there's not much to consider in terms of take profit, because remember, when you're buying, you have to sell to close, and to sell we use the bid line. So when the bid line hits your take profit here, if price came up, trickled up to here and hit this line, we will be taken out at take profit and we'll be good. Again, we're back on TradingView, so I want to quickly show sell stops and buy stops and how they would potentially work. So if this was the chart we were in and we were looking to sell, for example right here, and this would be my stop loss, for example, price is actually going to come down and probably trigger us in again here. Again, when you sell, you take the bid line. When you buy, you take the ask price. I know I've repeated this so many times, but if you don't know this and you haven't written it down, or you haven't got it secured in your head, then you're going to forget how this actually works. So if you have a sell stop and it's here, for example, price will trigger you in at the bid price, but your stop loss needs to account for spreads, otherwise you may get triggered in and stopped out immediately. Same for the sell limit. And again, when we're actually hitting take profit, the ask price is what's taken, as you have to buy to close. So if price came down here, for example, let's just pretend price came up down into this zone and it came here, but obviously your bid line would be where price is. But if your ask line was here and then price comes up like this and potentially ask line's now here, this would not have stopped you out at take profit, but you would have got taken out at stop loss. So in this scenario, this is why it's really important to be looking at spreads and understanding what's happening and what they actually do. Because in this scenario, instead of taking a win, albeit a smaller win than needed than you anticipated, you would take a loss instead, which is not good at all. Quickly show an example on buy stops as well. So right here, for example, again, I'm not marking a real trade. let's say this was the resistance point and you were a breakout trader. This was the zone that you wanted to break. So initially, what you would want to happen is something like this. Price might do something like this here and then do this. But your stop was potentially, you know, here. And your stop loss would obviously be below this key level here that you've got going on, and take profit whatever at this high here. So let's just bring this back down and do that. So if this happened, ideally what you want to happen is, you know, price is going to break straight out and then just go straight up. But that's not what might happen. Potentially, if price comes back up to this key level that we have going on here, let me extend it across like this. If your ask line is here at the entry point, you're going to be triggered in before you actually want to be. You know, price is actually still sitting down here, and we may get a rejection and we may get a sell. Now, in this scenario, you would have been triggered in, and if price continues to drop, then you're going to be stopped out unnecessarily. Again, your bid price is actually going to stop you out. So as soon as you're triggered in here, the price that you're actually getting immediately is this one right here. So price only has to move this far for you to be stopped out again. But this is why when you're doing something like this, you want to add spread to your entry. You just want to move it up potentially, and then that's just covering your stop loss again. Obviously, your target would be terrible at this point. That's a 1 to 2 if you were targeting the extreme high. But again, we're not trying to trade in this scenario. I'm just trying to explain how spreads work and why you should be sort of taking note of them. But there are the examples of buy stops and sell stops. We'll move on with the teaching. So now we know how spreads affect our buy limits, sell limits, buy stops and sell stops, and our market execution trades, buys and sells, and we know what spreads are and why they exist. Where can you actually find your spreads? So spreads can be seen in the quotes page on your MT4 or MT5, and even CTrader. Where all your pairs are, that's where your spread will be shown. It'll be either in properties or more info, or it may show just below the pair. You can also find your spread by enabling the ask line on your trading platform. For example, in TradingView, if you just right click, press settings and show bid/ask price lines, then it's going to show the ask line as well, and then you can work out the difference between the two lines, and that'll be your spread. Or alternatively, again on the quotes page, you're actually going to be showing your spread in ticks, which is actually, you know, 10 times smaller than a pip. You know, 10 ticks is 1 pip. So when it says spread is 10, it means 1 pip or 10 ticks, and it's not 10 pips. So make sure you don't go adding 10 pips to your stop loss and minimize your risk reward massively for no reason. Make sure you understand what that number is. Make sure you've written down all the notes from this video and you understand why that is happening. Alternatives to spreads, brokers obviously must make money, so they're never going to offer raw spreads, unless some brokers do actually offer raw spreads, which is when spreads are close to zero in most cases on most major pairs. The drawback to this is that they charge a fixed commission per lot instead of spreads. This is taken immediately when you take the trade. Even if you close it straight after, you're going to be charged as fixed commission. This is the best option if you're trading a precision-based strategy like myself. I trade smart money concepts, where my stop losses are usually below 5 pips. These spreads are so crucial, and I need a broker that I can rely on. Or if you're a scalper, the raw spreads option is definitely a great option in this scenario. If you are a swing trader, then it may not be as beneficial to you to have the fixed lots. Again, you won't be using much volume anyway, so it'll completely depend on how you want to trade. But for me, raw spreads work for swing trading, scalping, no matter what. It is the best option in my opinion. Spread peaks, even the best brokers out there, spreads still increase from time to time. High volume and low volume are the two keys to high spreads. Now, I know there's a complete opposites, but let me explain. So, when volume is higher due to news events or session handovers, spreads tend to increase. We tend to see this go from anywhere between, 1 to 10 ticks, anywhere between 50 and 100 ticks. It can increase massively during news events. This is why we tend to try and avoid it. if possible, because it is really hard to make money and predict how the broker's going to react to the news. Spreads also tend to increase during low volume times, such as 22 GMT. It's 10 o'clock GMT time, which is when New York session closes. We have an hour gap until the Asian session opens, and there's very low volume during this point. This is where brokers tend to clean up their data feeds and work on any schedule maintenance or anything like that. And spreads will increase during these times every single day, Monday to Friday. This happens. Again, 2200 GMT. So you really want to be trying to revoke your orders. If you've got buy limits, sell stops, buy stops, you want to be taking them out during spreads. Give it an hour or so, and then place your orders afterwards if you're still awake. This is the best way to sort of cover it. Best times to trade. This is purely in terms of spreads. I'm not saying this is the best times to trade for pips or making money or anything like this. This is purely based off getting the best spreads possible. Now, best times to trade are during London and New York session, when they've been running for at least an hour, and they're at least an hour before session closes, because that's when volume tends to spike before and after the session. Avoid news events and 10 o'clock GMT. You really want to be avoiding that. So below here I've got a chart that I've just taken off the internet. It's not very great quality, but it's there. So the New York session ends at 10 p.m. here, and then we have an hour before the Tokyo session opens. The Sydney session is actually quite low volume as it is, so this hour where Sydney session is opened, not a lot happens during this session, and that's why spreads tend to increase during this time. So from here you can work out you want to be trading between 8 and 3 GMT, or between 1 and 8 GMT. This is the best time for spreads. Obviously at 4 o'clock you're going to have a slight spike, but it's nothing compared to the 10 o'clock spike or news event spikes. So with all this in mind, hopefully you understand now how spreads work, how they can affect your trades, and hopefully I cleared up some information that was maybe missing as part of your trading knowledge. But other than that, thanks for watching. Make sure you leave a like and subscribe. Join our Telegram in the link down below. Follow our socials, all of that good stuff. If you do wish to learn to trade for yourself, make sure you check out the top link in the description down below, which will take you straight to our website, and you can get started from there. Other than that, my name is Ben, and I shall catch you all next time.